Today, bank risk, separating the sheep from the goats. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. I want to discuss probably the question that I get most from our followers, and that's simply this. How can you tell which banks are more or less risky in Australia? It's a very important question given the highly leveraged state of the banks here, particularly with regard to home loans, and the unclear situation with regard to the bail-in of deposits. And of course, as we've been highlighting, the $250,000 deposit insurance only will come into existence if the government chooses, and when a bank has collapsed completely. So the key question is, how do you work out where the risks are in the banking system and which banks are the most risky? Now, in New Zealand, the Reserve Bank there has set up a scorecard system where you can actually go and look at some of the key statistics, bank by bank by bank, and work out which is the most leveraged and therefore what is the most risky. Now, we don't have any of that in Australia. So we are reliant firstly on the disclosures of individual banks through their accounts, through their quarterly updates, and that includes a thing called the Pillar 3 update, which gives some basic information about risks. But that information is firstly quite hard to understand, and secondly is of course subject to the various vagaries of the accounting system. Now, because we can't actually get at individual information from a single place, bank by bank by bank, the best we can do is to look at the APRA quarterly banking performance statistics, which are released on a regular basis. And the most recent data to the end of September 2018 has just been released. So I'm going to start this exploration of risk by looking at the APRA data. It's not perfect, but it does give us at least a few clues. And if I start looking at the data, the first thing to say is that there are 143 ADIs or banks operating in Australia at the moment. That's slightly down from the 147 in 2017. And from a financial performance perspective, the net profit after tax of all the ADIs over the last 12 months was $35.8 billion, pretty much no change from a year ago. The cost-to-income ratio for all ADIs was 49.8% for the year ending September 2008, and that compared with 48.2% for the previous year. In other words, the banks have become less efficient from a cost-income perspective. And the return on equity of all ADIs was on average 11.7% for this last year to September, compared with 12.3% in the prior year. In other words, the bank's return on equity have dropped over the last 12 months, and that's explained by, firstly, margin compression, and secondly, lower volume growth. And we can go on and look at the total assets of all the banks. APRA says that the total assets for all ADIs was $4.72 trillion as at the 30th of September 2018, and that's an increase of $164.7 billion, or 3.6%, on the 30th of September 2017. And the total gross loans and advances for all ADIs was $3.29 trillion as at September 2018, and that's an increase of 4.9%, or $152.8 billion from the previous year. In other words, the banks have been growing their loan books. And in fact, it's home loans which has been the most significant contributor to that growth. Now, turning to capital adequacy, and this, of course, is what is used in the banking system to consider risks and also to try and get a handle on the way that the banks are structured. So the capital ratio, which is the total amount of capital put aside by the banks on average, was 14.8% as at the 30th September 2018, and that's an increase from 14.6% on the 30th September 2017. And the Common Equity Tier 1, or the CET1, for all ADIs was 10.6% as at the 30th September, a decrease from 10.6% a year earlier. Now that's important because the CET1 ratio is meant to be a better indicator of the amount of capital coverage that the banking system actually has. In other words, it's gone down over the last year. And the third category is risk-weighted assets. Now this is a bit complicated because what it basically comes to is that different types of assets, like different types of loans, for example, have different risk weights attached to them. So some of them are weighted at 100%, but some, like mortgages, are weighted at a much lower rate. So in fact, the true risk weight is lower than the total amount of assets outstanding. So the risk-weighted assets for all ADIs was $2.02 trillion as of September 2018, and that was an increase of $68 billion, or 3.5%, from a year earlier. And that is because a lot of the growth has been in home mortgage lending, and a lot of that home mortgage lending does not require 100% lift in weighted assets from a capital perspective. And then we can go to impaired facilities. So this is essentially trying to get at what proportion of a bank's assets are at risk based on potentially loans not being repaid. Impaired facilities were $11.7 billion as at the 30th September 2018, and that's a decrease of $0.3 billion, or 2.3%, on the previous year. Now that's interesting because what that basically says is that the amount of assets at risk judged by the banks has dropped, which may be a little surprising given the current environment that we find ourselves in. Also, past due items, that is the amount of loans that are behind from a repayment perspective. Past due items was $16 billion as at the 30th September 2018, and that's an increase of $1.7 billion, or 11.9%, on the previous year. So ask yourself, how can impaired facilities go down when past due items are rising? And the short answer is that's an accounting judgment, and there is a benefit to the bank of writing impaired facilities down because that increases profitability. I personally think that could well be understating the true state of affairs. Now, the impaired facilities and past due items as a proportion of gross loans and advances was 0.84% as at the 30th September, and that was a slight increase. Now, the impaired facilities and past due items as a proportion of gross loans and advances was 0.84% as at September, and that's pretty much the same as the previous year. The specific provision, so this is now when you have named items that you actually think are at risk, the specific provisions were $5.7 billion at 30th September 2018, and that's a decrease of $0.3 billion, or 5.6%, on the 30th September 2017. And the specific provisions as a proportion of gross loans and advances was 0.17% at September, a decrease from 0.19% a year earlier. So what this tells you is that the impairments and the specific provisions relative to the total loan book is about the same or slightly lower because the value of loans has increased. Now, that's all at an aggregated level. So that's taking account of major banks, regional banks, foreign banks, credit unions, and building societies. But things get interesting when you delve more deeply into each category of a lender. So what we're going to do now is we're going to look at the statistics at the most granular level we can, which is not at an individual bank or ADI level, but in that grouping. So we can look at major banks, we can look at regional banks, we can look at foreign banks, we can look at credit unions, and we can look at building societies. And to do that, we've created a set of standard charts. So I'm going to start with the building society's performance to September 2018, because I'm using this as a bit of a template. So this chart shows you a few different things. Firstly, the red area shows you the housing loan value held by building societies to September 2018. And you can see that there's been a step down in housing lending from building societies. That's because the number of building societies over the last few years have converted themselves into banks, and so will switch to category. The blue area is the total gross loans and advances. So that's home loans and all the other types of loans. And you can see that for building societies are predominantly home lending institutions. And you can read those particular scales on the left-hand side to understand that the total amount outstanding is around $10 billion. Now, if you look at the scale on the right-hand side of this chart, you can see that there are a number of lines. The first line at the top, the green line, is the capital adequacy ratio. And that's effectively the total amount of capital weighted against the total exposures of the bank. And you can see that that's sitting at around 20%. And then just below it, you've got the CET1 capital ratio. That's the new one that was brought in a few years ago, and effectively is meant to be a more accurate measurement of the risks in the system. So that tells you that building societies have a CET1 ratio of around 20%. So that's pretty good. So there's a 1 in 5 coverage. The next line is the blue line, and that is the Tier 1 capital ratio. So the thing to understand there is that there are effectively different categories of capital. Tier 1 is the highest quality capital and is the one that essentially offers the most protection should a bank get into difficulty. So we want to look at the Tier 1 rating. And the Tier 1 is actually sitting at around 19%. In fact, it's very close to the CET1 capital ratio. And the last ratio that I've created is the ratio between the share capital or owner's capital held compared to the gross loans and advances. So this tells you how much leverage there is in the system. Basically, the higher the number, the more protection there is for deposits and other types of bail-ins. And in the case of building societies, there's a 10.2% ratio measured as at September. So in other words, there's a 1 to 10 ratio between gross loans and advances and shareholder capital. So even building societies are quite leveraged, and of course that's how banks make a lot of money, because effectively it's not the shareholders who take all the risks, it's the people who are borrowing and depositing in the bank. Anyway, so that's building societies. So remember, 10.2%. Now, if we then go to credit unions, and now credit unions is another type of mutual, a few more in Australia, we get a rather similar but slightly different story as well. So the credit union's financial performance to September 2018 shows that the gross loans and advances peaked at $45 billion and has fallen now to around $30 billion. And home loans make up the vast quantity of gross loans and advances. Again, we've seen some consolidation of credit unions. We've seen some credit unions become banks. So That's one reason why we've seen a fall in balances. The other reason is that post the GFC, some smaller organisations were perceived by consumers to be more risky than the majors, so they tended to switch some funds from credit unions and building societies to some of the main banks. Now, if we look at the Tier 1 ratio, we can see that's sitting at around 15.5%, and the CET1 ratio is sitting in a similar area. And if we then look at the ratio between the loans and advances and the owner shareholder capital, you can see that they come out at 9.9%, so slightly lower than the building societies, but still looking reasonable. Now, they are still leveraged, but from a risk perspective, 9.9% is not too bad. Now we're going to turn our attention to other domestic banks. And these are excluding foreign banks and also the major banks. And here you can see that there's been a considerable growth in loans and advances, up to 300 billion. And you can see that the home lending portfolio has grown, but you can also see that they have a greater share of, for example, business lending and other types of borrowing, as well as home loan lending. And you'll see that there was a drop in 2008-9. Again, this was because of the fact that after the GFC, people switched from some of the smaller banks to the big four, thinking that they were safer. Now, if you look at the capital adequacy ratio, that's sitting at around 14%, which is quite high. And you can also see that the Tier 1 capital ratio is sitting at around 12%. The CET1 ratio is sitting just above 10%. And the ratio of loans and advances to total shareholder capital is 7.1%. Now, that's a lower ratio than we saw in credit unions and building societies. So that tells you that these domestic banks are more leveraged. In other words, they have a lower level of buffer before they would need to call on convertibles or maybe even deposit bail-ins if things started to go wrong. So relative to credit unions and building societies, though they're bigger, they are actually more risky. So now we're going to look at the four major banks. And immediately that you can see how much larger they are, the total loans and advances outstanding are sitting at about $2.5 trillion, way bigger than the others that we've looked at before. And you can also see that home lending is extremely large as well, up to about $1.5 trillion. But what's really interesting is when you start looking at the ratios. So the capital adequacy ratio, which is that one which is essentially based on the risk weights that we discussed earlier, is sitting up around 15%. So you might think that sounds pretty good. And then if you look at the Tier 1 capital ratio, you can see that that's around 13%. And the Common Equity Tier 1 capital ratio is sitting at around 11%. So all of those sound pretty good. But here's the kicker. If you compare the total share capital against the total loans and advances, major banks are sitting at about 5.25%. And if you look at the trend, it's going down. So they are nearly double leveraged relative to, say, credit unions. So this tells you that from a risk perspective, not a risk-weighted perspective, but from a pure risk perspective, the major banks have a much smaller buffer from a capital perspective should things get difficult. Now, they can clearly call on their convertibles, and ultimately they could even bail in deposit if required. But the point I want to make is that the major banks in Australia are massively leveraged. Only 5% of the equity is provided by shareholders. The rest of it is in the banking system itself. So another way you could put it is that compared to the other categories of banks, the major banks are twice as risky. Now, you could also argue, I suppose, that they will have better systems and processes and perhaps better intelligence to be able to deal with this. So therefore, it should be okay. But of course, as we saw from the Royal Commission, there are a whole bunch of questions about the processes within the banks, the way that they assess risk, and indeed the basis on which they have made loans. So my personal view is that the major banks are perhaps a little more risky than is generally recognised to be the case. Now, I will, just for completeness, also cover the foreign banks. It's, though, a little complicated because there is something that we need to understand about the way that the capital adequacy works for foreign banks. Of course, there are some differences between different types of entities, and the capital adequacy time series covers different capital frameworks. We need to, therefore, as APRA says, to be aware of some of these differences. For example, under the Basel II framework, exposures to holding companies of ADIs and equivalent overseas entities were deducted on a 50-50 basis from Tier 1 and Tier 2 capital. And under Basel III, the entire amount is reduced from regulatory adjustments to CET1 capital. In other words, the ratios are different for the foreign banks. So you can't necessarily compare them the same way with the ones that we've looked at earlier on. Now, that's quite relevant and important when you actually look at the foreign bank data. And you can see, first of all, that they have around 120 billion of loans outstanding, and the home loans make up quite a considerable proportion of the total. And then if you look at the ratios, you can see that the capital adequacy ratio looks reasonable, as does the Tier 1 capital ratio, but there are some weird things going on with the CET1 because of this Basel III change. And you can also see that the share of capital to gross loans is sitting at 3%, but as I've explained, that's partly because of the way that the calculations are done. So I don't necessarily think that we can conclude that foreign subsidiary banks are significantly more risky than the four majors. My conclusion is that it's actually quite hard to get a good read on the structure and risk profiles of foreign subsidiary banks in Australia. So, to try and summarise all of this, and I'm sorry if this has been a rather long and complicated discussion, but that's the nature of the beast, I'm afraid. My conclusion is that if you want to avoid the worst risks in the system, then you might want to consider some of the smaller players, particularly the credit unions and building societies. Now, they are small, but they are also quite well managed and have much more protection in terms of a downturn. The major banks are much more leveraged and therefore are potentially more risky, and the other regional banks are sitting somewhere in between. Now, hopefully I've been able to give you a little bit more information about the way that risks are considered within the banking system. It's not ideal, it's not perfect, and we are, of course, reliant on the APRA data, which is somewhat delayed, to be able to make these assessments. But to recap, there is no consistent bank-by-bank data available in Australia to enable people here to make direct comparisons between Bank A and Bank B. We think that's a major gap, and it's something which we think needs to be addressed. It's also worth noting that the APRA Act specifically excludes APRA delivering information on individual banks. So that's why they report at an aggregated level. So if we wanted APRA to start reporting on individual banks, like the Reserve Bank in New Zealand has started to do, then we would need to get the APRA Act changed. I think that's something that we should be lobbying for personally. So in conclusion, my view is that we are at a significant disadvantage relative to New Zealand in terms of our ability to be able to assess the relative risks across the banking system. And I have to say that it is not completely clear as to how much risk there is and where it lies. Of course, each of the categories that we've looked at tonight are just averages across all of the entities in those particular sectors. So before I go, let me first remind you that we are streaming live on Tuesday at 8 p.m. Sydney time. That's the 18th of December. And you're welcome to join in the chat or send me a question beforehand. Here is the link to the session. And if you'd like to support what we do, you can do that by joining our Patreon program or indeed making a one-off donation via PayPal. And here are the links for those facilities too. We do really appreciate all the support. It helps us to make the quality content that you've been used to on this channel. So if you like what you've seen here today, please like the post, share the post, add a comment or question, and do subscribe to receive future updates. Ring that bell. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.